So like that, have your own benchmarks in mind. Stay true to yourself and your principles. Set these things up before you start investing and know yourself. Have this again forms the basis of an investment plan. If you stick to a rationally thought out approach, you would have a much better return and much better chance of making money than not having thought about these things and just winging it.
Welcome to the Teaminvest Wealth Builder podcast, where we help you build smarter wealth and make more confident investment decisions. Well, welcome to this week's episode of Teaminvest Wealth Builders podcast. Today, we're talking about something that every investor should have in place, whether you're new to investing or you've been doing it long term, and that's a clear set of investment principles. This is going to allow you to navigate the market conditions, whether they're volatile, whether they're stable, whatever's happening in the market with confidence. Today, I have with me Sanji Narendran, who is our Head of Funds Management and Education. And Sanji, to start this conversation, what would you say are the important investment principles for people to have in place?
I think there's three principles that we should all have in place before we even think about starting and making an investment.
Yeah.
First, I'd say know yourself. Know yourself as an investor. What are you comfortable with? How often do you want to transact in the market? What are you looking to achieve?
Yeah.
And know everyone's got a different personality type.
Yeah.
And what are you likely to do? Then once you've understood yourself, you really want to understand the type of businesses that you're going to invest in. Is there a circle of competence around you that you have and those type of industries that you're looking for, or a style of investment that you want to pursue? So understand your investments. And then finally, once you've understood yourself, you've understood the investments, then find a way of creating a valuation that works. How are you going to value that investment? How are you going to follow what is that? Is it going to be at a good price? Is it going to be at a high price? Is it going to be at a low price? And have your own benchmark for what that valuation is going to be.
Okay, so let's break down each of those for our listeners. So starting off, know yourself as investor. How do we do that? What are the things that we should understand?
You should look at your own personality, right? My style of investment and how I am as an investor has changed a lot over the years. So when I first started investing, and I've talked about this on a previous podcast, it was with my father, and we were investing into blue chip companies and we were using a little bit of leverage on there as well. I mean, conservative with the leverage, but we were using some leverage on there. And but we thought we were safe in the blue chip investments.
Right.
And we were just not too many companies, as we're talking really in the top 20 of the ASX. And we thought market cap was a great indicator because there's so many people invested in these companies that you can't go wrong. There's a lot of information out there about these companies. So it'd be easy enough to understand those. Obviously, the GFC hit, changed the whole landscape, and we got hit with that. It kind of spooked me, and I stopped investing for a while. But part of me stopping investing had to do with what I was doing for my day job as well. So even though I was working in the markets and I was trading on behalf of clients, one of the things is when I stopped and thought, okay, if I'm going to invest, I can't do what I did before. That strategy obviously doesn't work when things go haywire. But what type of strategy would I impose at that time? And I was working with clients that were very frequent traders, a lot of day traders. So most of my career I've been working with day traders, and I started to understand how they make money and how the good ones were making money and how the ones that weren't so successful were losing money. So in spending time, I understood the day trading landscape of it, but I couldn't do it because I was too busy investing and trading on their behalf. So to try and be a day trader, it's a lot of work.
Yeah.
So I always told myself that if I was to invest again, it would be when I am not working full time, and then I could probably day trade because I think I understood the market movements enough to make small profits on small movements, um, and not have to take large amounts of risk that way. Uh, but I understood enough in that area, having dealt with a lot of the best day traders as well. Um, Although saying that a lot of the best day traders, there was only very few of them. But having watched them and see their approach being so disciplined, and I think I could adopt those and make that work. But I just couldn't do it while I was working, so I just stayed out of the market. The other option for me was to find great companies and great businesses and decide to invest in them. But that also spooked me because, in the broking space, what you think of as a great business and would be based on the market cap. You think the larger the business is by market cap, the better it's going to be.
Yeah.
But I knew it wasn't because I was running a business at the time and I was operating and knowing what goes into profits. And I look at these big businesses and go, oh, I'm really not sure about this. So is that something I really want to tie my money up to? Because I've seen the top companies in the country fall. So is that something I would just park and leave it just because I couldn't be active?
Yeah.
And it wasn't really for me. So I kind of parked all investment in equities aside, um, focused on property for a little bit and invested a little bit into the property market. And then just when I had the time, when I was able to then come back to a place like Teaminvest, my investment style completely changed again. So it's just understanding your personality, finding a style or investment strategy that fits you.
Yeah.
Um, but I know you've been around the industry a bit, Kerry. What about you? What's your investment personality?
Yeah, so I know my background's very different to yours. I worked in financial advice, those spaces. But I know myself, and I know that as a personality, as a person, I'm fairly reserved. I really want to understand something before I step into it. I'm someone that'll do all of this study, just to understand something, understand how it works. So I found myself often, when I was working previously to coming into Teaminvest, that I often just looked at funds, particularly index funds, simply because they're not hard to understand, and they're the cheaper option.
Yeah.
I was looking at other funds that were the more expensive options that were declaring that they were going to do all of this amazing things, and then it wouldn't happen. And it was kind of like, oh, this is kind of starting to feel a little bit like guesswork. So kind of stayed in that
Yeah.
safe space, or what I thought was the safe space. But I must admit, since coming to Teaminvest, which I've been here nearly a year now, just really being able to understand the companies and the way Teaminvest works. It really works to the way my mind works. There's that real logic behind it, that real, okay, this is the reason. If you do this, this is the outcome that will happen. And this is the reason why. So it's that real understanding of the companies. I must admit, I'm not there yet. I've only been in nearly 12 months, and obviously have a full-time job to do as well. But what I've found is I've embraced it. And I've been able to invest into the funds which follow the same process and methodology. So I've been able to do that with the idea of slowly being able to, invest myself as I start to understand the market a little bit more and understand the companies. Not really the market, it's really understanding those companies that I want to invest in.
And you've done absolutely the right thing. You've understood yourself as an investor. You know where your risk profile sits and what you might do in terms of at times of noise in the market, and are you going to get nervous about it? Are you going to lose sleep over it? Are you going to get jittery? Are you going to want to take your profits? You know yourself. You know what you're likely to do in these type of situations, especially when there's a lot of hype and noise about things, making people unsure.
Yeah.
But if these are things that affect you, then great. The funds are a great option for you. Say,
Absolutely.
I get the principles, I understand the principles, but I don't want to be hands-on in control of every minute detail of when and what and worrying about that now. Let me get a lot more comfortable with my understanding of the businesses that I'm going to invest in, and then I'll do that later. But until that time, I trust the process. You like the way things are operating, so let's let the fund manage the money for you, right? So that makes a lot of sense.
Yeah.
And it was the same thing for me as well, right? Because I knew that I wanted to understand the businesses better.
Yeah.
And I knew that the information I was getting, even in the market as a broker, was just not enough of an understanding. It wasn't, it was just a lot of noise, and there was a lot of very shiny pictures being shown, and
Absolutely.
great documents with very great marketing behind
Makes it
them.
great.
It does. But, you know, things weren't just adding up. It's like, yeah, but there's a lot of risk in that amount of debt you're carrying over there. Or what are you going to do when you haven't really been growing these profits for so long, or your returns really aren't that great? So what's going on? Is there a reason for this? And it takes a lot of time to understand these businesses and trying to look at it, especially when you can't narrow it down. You're working with at that time, you're really working with a range of the whole market. So you're trying to find the best companies in a group of 2,000.
Yeah.
And what Teaminvest has managed to do for me, and I can see for you as well, is really narrow that down so you can focus a lot more on a handful of the best companies and then say, okay, let me understand those ones. So it really gives me a lot of direction as to what to do. But whether you're going to go down this way or a different way, to understand whether you're, what your investment personality is like.
Yeah.
When things are going great, are you the type of person that's going to cut your profits and run? Are you the type of person that's going to want to double down and say, okay, things are going to be great. I've got this huge endowment bias now and watch us go to the moon?
Yeah.
Or are you going to be able to say, look, this is a great company. I'll just sit it. It might go up. It might come back down a little bit, but I know the underlying business well enough to be comfortable in sitting in it, like a lot of Teaminvest members do.
Yeah.
Or are you a day trader that you need to be in and out and just, on to the next big thing and trying to catch every wave possible? And yeah, that works for some people. And I know, and research probably in your career, you would have seen it as well, that tells you that it works until it doesn't work anymore. But, and I know you're in financial services, but also in the compliance side of things. So a lot of the education that comes out there kind of tells you, go to the index funds, go to the ETFs. That's the safe place to be, right? And it makes sense. And you see even Buffett turns around and says, look, if you don't know what you're doing, or if you don't have the time to sit and actually spend any time on it, or you don't have the inclination to want to spend time on it, an index fund is great to give you a return.
Yeah.
So invest in an index fund, you follow the market index and you go along your merry way with the low cost, which is totally appropriate for those type of investors if that's their personality.
And you're invested.
That you are invested. It's better than doing nothing or keeping cash in the bank for sure.
Yeah.
But at the same time, sticking with the average, sticking with the market, going into the index funds will only keep you at that average. So it's more about a preservation of capital, which is totally not a bad strategy. It's totally fine. But I'm looking to grow my capital. I'm looking to grow a lot larger than that. I work hard. I earn my money. I want to see that grow as well. So in retirement, I can be nice and comfortable and make sure my family's comfortable as well.
Absolutely. So really, in knowing yourself or knowing how you are as an investor, It's looking at your personality. It's having a look at how do you react in or market volatility or even just volatile circumstances. So, are you someone that's reserved or are you that adrenaline junkie?
Yeah.
And then it's kind of going, okay, and what's almost like your risk factor? What are you happy to risk? How much risk are you happy to take on?
Yeah, that's right. Because at some point, whether you decide, oh, I'm going to sell it at a profit or cut my losses, there's there's got to be some parameters, and you want to understand that of yourself.
Yeah.
And set them prior to making these investments when you're not affected by all different noise and so on as well, because the emotions at the time are so overwhelming. You don't feel it, you don't realize it, but they do get so overwhelming. And I know, because my whole career I've been speaking to people investing their money in the markets and trying to make profits. At that time when something's going really great, you get on a really strong high and everything's so rosy and positive about it. And there's other times where things are going so bad and things are not looking good, and you're sitting there wondering why,
Yeah.
I don't know. Should I stay? Should I go? And the time it takes for you to make a decision, by that time it's often too late.
It's that old FOMO, that fear of missing out that,
Yeah.
you try and resist going with the crowd, but then it just all gets too much and you just jump on in and usually you've missed the boat at that point.
Yeah, and I remember watching, there's many times in my career I've been sitting around with a group of other traders and colleagues and stuff like that, where we'd be watching a stock just have this meteoric rise, and you see it really early in the day, and you see this thing is just going, oh, it shot up 20%. Then next thing you know, you refresh the screen and it's now at, 50%, now 80 and 100 and 300%. It just keeps going up and up and up. And at some point, once it's jumped 2 or 3 times, you're thinking, should I get in? Should I get in? Should I get in? By the time you think, okay, I'm ready to make the decision, you're looking at it going, ooh, can it really go up any more than that? And you rethink it quite a few times. But I've kind of always sat back and said, you know what, it's not for me. I'm not going to be able to make that decision quick enough. I'm not prepared for it. I wasn't banking on this happening.
Yeah.
So I'll sit it out and let anybody else make a quick buck off it. That's great. But I'll sit this one out. But a lot of people, they jump in at the right times, and a lot of people, they jump in at the wrong times.
Yeah.
And I've seen many people jump in, make a quick buck on it, and then jump back in and then turn around and go, oh, I've lost everything I just made.
Oh. And that's it. And I guess that comes back to knowing your personality, right?
That's right.
So once you know your personality, what's the next principle that we need to move into?
You want to know what you're investing in. So if you're going to invest in direct equities or an index fund or whatever it is, if it's a managed fund, understand the process of it. What is that company? If it's a direct equity, what does that company do? How is that been performing? Is it likely to continue performing? Are you just following the crowd, or are you really understanding that business and that industry? Or if it's an index fund, it's like, which index are we following? How is that index performed? What is that index made up of?
Yeah.
And can it continue performing at levels that it's currently performing at? Or if it's a different fund that's made up of different indexes, you look at the same thing again. Or if it's an active managed fund, who are the fund managers behind it? What is their methodology? How have they been operating? And I know you did a podcast recently with Stuart, with a lot of deep dive questions into who the fund manager is and questions that you should be asking before you make a investment decision into an active fund. I thought that was a great way of doing a bit of a due diligence on understanding what a good fund manager is and what type of strategy you'd be involved in.
Absolutely.
So I'd encourage people to do something similar. And even if it's a passive fund, you could do the same thing, saying, okay, it's passive, it's just doing X, Y, Z, and it continues to do that. is that a strategy that'll continue? Not just because a lot of people are jumping on board and the funds under management are going up,
Yeah.
but who are the managers? How are they being incentivized? And are they in line with what they're investing in? Or are they only in line with how good a salesperson they are?
Yeah. So if we, because you mentioned that we have done actually 2 podcasts. It was a 2-part
Yeah, yeah.
podcast where we went through looking at funds and identifying what a good fund was. And I'd recommend you jumping back if you're looking at funds and investing in funds. We actually have a tool that's available to our audience there as well. That's almost like a due diligence checklist. So if we move the fund aside and just look at identifying companies, because we talk about
Yeah.
investing directly in companies, in stocks. So how do you know the company? What should you know about a company to say that you understand and know this company?
Well, we usually start with, what does the company do? How does that company make money? Now, sometimes it's obvious, sometimes it's not so obvious. The example that I always use is McDonald's, because everybody knows it. Everybody knows that it's not just a burger chain. They're actually a property business.
Yeah.
They make a lot more money off their property and their rental incomes than they do with off the franchises. They ensure that each franchisee makes quite a bit of money, but they make good returns off being in the property business.
Yeah.
So you scratch the surface, because normally you would expect a fast food franchise like that, or a business like McDonald's to be, oh, you sell burgers, you sell fries, you upsell, and you sell Cokes and all these kind of things. Um, they're all part of making the franchisee money, which will have a flow-on effect and get great rental returns on their properties. But that's what they do. They do that really well. But so you got to scratch the surface sometimes and really understand that business. Not just think about, what does the company make? What do they sell? But are they serving a market need?
Yeah.
Is that market need likely to continue? Do they have uh, some a core part of the market that they're continually able to sell into, or is it just some sort of niche area where they're capturing that niche market? Could they expand that into other areas? But what is it that they have? And recently we've been comparing CSL to Coca-Cola in a lot of the Teaminvest masterclasses.
Yeah.
And people think, oh, CSL, Coca-Cola, how can you make that comparison? But Andrew had been discussing this for a while now, and it seems like CSL's got on board and they've realized what CSL does is not just blood and blood plasma and vaccines and things like that, but they're the world's largest distribution company or logistics company when it comes to transporting these type of medical. I think biohazardous is really
Yeah.
the right word, actually. So yeah, they're able to transport this all around the world. So that is a huge moat. N- Now, now that they've discovered that they have the logistics to be able to scale and send something around the world, they don't have to spend so much money in R&D. They can have other companies that do R&D a lot more efficiently develop the businesses or develop the new treatments and things like that, and acquire them. And by being able to acquire them at what might be material for that company, but it may be immaterial for something at the size and scale of CSL, and then scale it up to where CSL can scale it,
Yeah.
that is a huge advantage for them. And not many businesses have that type of advantage. Coca-Cola obviously does, when they realized that rather than spending so much money on um, developing new drinks, they just buy the ones that are performing the best, scale them all around the world, and everyone can have a can of whatever new flavor and new drink that they want.
Right.
I mean, their distribution is enormous. So they learn from things like that and be able to grow their business in that way. But you've got to understand, what is that business? It's a logistics business that looks like a medical business.
Yeah.
Is it a distribution business that looks like a bottle, a soft drink business? those type of things. Scratch the surface, understand it a little bit more deeply. What is the true business behind it? What market need are they selling? If it is just their product, and maybe on the smaller scale of businesses, that tends to be the case. But how are they able to service their industry, and what foothold do they have, and why do they have it? Could they become knocked off their perch if a competitor was to come and do something a lot better?
Right. Okay. So you know yourself as an investor, you know the company. What's the next step?
So once we know what we're like as investors,
Yeah.
we know the type of investments that we're going to invest in, or whether it's direct businesses or funds or whatever you've done your research into.
Yep.
Um, you've got to decide, how do I want to value this investment? Now, everything will have a valuation. What is it worth to you? And how are you going to measure it? And there's a lot of different valuation methods. John Price, one of our founders, had talked about different valuation. I know he does a great topic on that. But he explores the different type of valuation methods that are out there in the market, and discounted cash flows and all these kind of things, that these different models that people use. And most of them, if you are putting in a lot of assumptions, you're going to get out a lot of junk.
Yeah.
So how can you fairly value a business? So the way Teaminvest does it is, we cut out all the noise.
Yep.
And we say, if we were going to buy a business in a private equity sense, or, if you're going to buy a business in its entirety,
Yep.
how do you value that business? Not just what everyone thinks it's valued at, but how would we value what it's worth to us? Means, if we buy that business becomes ours. All their debts become ours. All their liabilities become ours. All their profits and all their sales and everything becomes ours.
Yep.
And if we were to take that on, and the people that have grown it need to be compensated for what they're selling.
Yeah.
Now, how much would you be prepared to pay to compensate those people? Now, if they've been able to produce a business that returns 5 million a year, would you give them the 5 million for the next year that they're not going to be running the business, and say, thank you very much? I'd love to. They might not accept.
Yeah.
They might want 10 million. They might want 15 or 20. So then it becomes a negotiation tool, but you're valuing it based on the profitability of that business.
Right.
How much that business is returning. That's what the management has done. They've been able to make a business that returns X amount. We're going to pay a multiple of that. So you're compensated for your next 5 years of potential earnings, and you don't have to do anything, and we'll take on all the responsibilities hereafter.
Yep.
Right. And then I know I might be able to get some synergies. I might be able to, cut some cost and do whatever to change the business landscape. And then the value to me is a lot more than what I paid to the owner.
Yep.
Right. You don't have the same hands-on tools to make synergies and cut costs and do things when you're buying shares in listed equities market.
Yep.
So how are you going to value that? There's no reason to change it, but just understand that you don't have the ability to cut these things or be hands-on with those type of decisions unless you're taking a very, very significant portion of that business. But you just say, okay, this is how much the returns are. This industry generally gives you X number of, years of profits. That's how you would normally value it, or PE ratio,
Yep.
a price to its earnings. So we come up with a price or a valuation based on the amount that the business is earning.
Yep.
And that's something that we've been using John Price has been using it for about 24 years. And the rest of the Teaminvest members have been using it for almost as long as he has. And that seems to work really great for us, because we've been able to follow companies, and we know that their PE valuations, they go up and down. The market then adds in what they call sentiment, right? So we leave the fundamentals aside and they go to sentiment. And as with all groupthink and hype and marketing, we can push sentiment and you can push it for a while and something can be overhyped for a certain period of time until it's not anymore. And then you got a new flavor of the month.
Yeah.
Right. So you've got to create a valuation based on what you feel it's going to be worth and then peg that against, okay, this is what the market is valuing it. Just because the market's in love with something doesn't mean you have to love it. Just because the market's out of love with something doesn't mean it's great.
Yeah. Yep. And I guess that's where it comes back to the knowing the company piece, which was step 2.
That's right. So if you know it, you don't have to rely on whether the rest of the market's in love with it or not. You don't have to try the new flavor of the month. And I think right now everybody's into the Dubai chocolates.
Oh, yes.
Seems to be the thing. Yeah. Not a fan. But I can make that decision because I know what I like.
Yeah. Yep.
I know what my taste is, my preference is, and great for anybody else that wants to have it, but it's not for me.
Yeah.
So like that, have your own benchmarks in mind, stay true to yourself and your principles, set these things up before you start investing and know yourself. Have this again forms the basis of an investment plan.
Yeah.
And if you have this, then really what happens here on after, if you stick to a rationally thought out approach, you would have a much better return and much better chance of making money than not having thought about these things and just winging it.
Yeah. And even that whole piece of sense of peace, that sleep at night test.
Oh yeah, absolutely.
All comes into play.
Absolutely. You want to make sure that you're comfortable. You don't stressing out just because a company, for me, most of the time I'm buying into a company, it's when the market's falling out of love with it. So at the time, I don't know how low it's going to go. I don't know where the bottom's going to be. But when I'm buying into a company, the market's falling out of it and generally means every purchase I make, the share price just keeps dipping straight after it. So I'm happy with the price I paid. I know immediately I'm not going to see a profit on that trade, on that purchase. It'll show all the new stocks that I have all showing red and in their returns. But I'm okay with that and I can sleep at night knowing that, yes, I bought CSL on the way down, didn't get it at the bottom. It kept falling, but I'm comfortable because I know it's a great business.
Yeah.
I know the moats around the business. I know that they can continue to grow at the rates that they're expecting to grow at. And they've done so for a long time. I'm comfortable. So it's each to their own. But because I know me as an investor, I know the business I'm investing in, and I had my own valuation as to what I'm prepared to pay.
Yeah.
I didn't buy when it was at $300 or close to it. I was buying on the dip on the way down. Yes, it's going to fall, but further than at a lower price than I bought it at. But I'll just wait that out.
Yeah.
Because I know over the long term, I'm going to be so much more in front.
And you know that you bought it at your fair price.
At my fair price and my fair valuation.
Yeah.
That's right.
Okay. Look, thank you, Sanjay. I think you've given people a really good reason to have that framework in place, to be able to go through the highs and lows of investing and know that you've got that framework that you can stand true on. You know who you are as an investor. You know how to understand the companies that you're invested in, and you do understand the companies that you're invested in, and you know the fair price. You know the price that you're prepared to pay.
That's right.
To go into those companies.
Yeah, but I mean, what really helps me is not having to do all of this by myself. Because if I was to try and do this by myself, I probably, in all honesty, I know me, I would not have done it. Right? But having done this through the process that Teaminvest creates for us, it's inevitable. You just have this process already done for you, and you're doing it together with a group of people. So I'm naturally following it just by being a Teaminvest member. But yes, trying to hit this and do this, it can be a lonely road.
Absolutely.
Doesn't mean you shouldn't do it. You should absolutely do it. But if you can find some like-minded people that are in the same sort of space as you are in knowing themselves and how they want to invest, and if you find a group of people in that same category, then it's really good and helpful to bounce ideas and understand each other and understand the investments in a lot more depth.
Absolutely.
Yeah.
Absolutely. And like you said, a much less lonely road.
Yeah, that's right.
Well, look, thank you for joining us today. I hope you found this conversation really valuable. And please click like, follow us, and share this podcast with anyone that you think would find value in it. Thank you, Sanji, for joining us.
Thanks, Kerry.
And we will see you all in our next episode. The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs. Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.